Guys, big week this week. GameStop, first off, before we go any further, GameStop, Roaring Kitty had his live stream last week. There were 500,000 people waiting on the live stream before he even got on. On Thursday or Wednesday, we were looking at it. It was like 15,000, which was insane. It got to 500,000. The stock was at $60 pre-market on Friday. Look at it now. This is Monday, 27.38. 27.38. And GameStop did a brilliant thing. They went and sold some shares to get some cash in their pocket. Absolutely smartest thing you could do as a company. Take advantage of this hype and euphoria. Take advantage of this insanity, right, Mo?
Yeah, why not? Why not?
This is a company that is losing money, losing cash flow. I actually had free cash flow last year of $170 million.
Everybody in here is laughing.
But I look at this gross profit of 25%. I mean, there is no reason to want this. However, I think their balance sheet looks pretty awesome. I mean, look at this. Market cap of 8.5, $8.7 billion enterprise value, which means you net off the cash and the debt. It's basically debt-free. So the question is, can GameStop itself turn itself around into being a viable company? If it does happen, it's going to have nothing to do with Roaring Kitty. But just show you the volatility. As Roaring Kitty was going live, the stock was falling and falling and falling. It got as low as $26, $27 a share, and now it's stuck at $27. The big number for Roaring Kitty, his call options are $25 on June 21. So he needs the stock to stay above that. That's just for the call options. Now, not a very big week for earnings. We've got a couple of companies we're going to look at. Oracle tomorrow, Adobe on Thursday. Local Akron company, Signet Jewelers, which has had a massive turnaround from the lows of $11 to $12 a share back during COVID. They're up over $100 a share. So kind of a boring week from the earnings release perspective. However, Wednesday is a big week. Mo, what is going on Wednesday?
Fed is going to announce if they are going to change rates at all or keep them the same.
And same day, CPI.
Oh.
Same exact day, we have both of those reports coming out.
The world may explode.
We
have 2 videos coming.
So make sure you watch this channel. Make sure you subscribe to this channel if you like earnings releases, information on the market. We're going to have 2 videos on Wednesday. So do me a favor, subscribe to the channel. Make sure you're here, not just for this week, for all future weeks, because whatever happens in the market, we are reacting to it as it happens. Mo, go ahead.
So there's a 99.4% chance, according to the Fed Watch tool, which is basically the market's prediction, that rates are going to stay the same on Wednesday. When are they accounting for more than a 10% chance of a rate cut? What future date is that happening? That's September 18th.
What's that percentage?
That is a 46.7%.
Oh, wow, so it jumps up pretty high.
I will say the July 31st meeting, because you said over 10%, only 8.8% say that we're going to have a rate cut.
Interesting. Yeah. Very, very interesting. Now, another thing that happened that starts this week that I want everybody to pay attention to, good old Nvidia. We have a video coming out on Nvidia soon on our main channel, Everything Money. Guys, Nvidia just had its stock split. And this thing has been volatile today. It did its 10-for-1 stock split today. And it was down upwards of 3% at one point just minutes ago. So it's a very volatile stock. Remember, Jensen Huang, the CEO, said that he wanted the stock split to allow his employees to get more active and retail investors to get more active. AKA, he realizes the hype. He just wants that hype trim to continue. The guy's signing bras. The guy's doing all these things.
He's no dummy.
He's no dummy. He ain't no dummy. And he's going to keep doing that to keep that price going. This is an incredible business with amazing growth in the last year and a half, 2 years, and amazing future potential. The question is the stock price relative to value one that makes sense? That is the main question there. Another big news this morning, a company that I own. Remember, don't buy it just because I own it. Never buy a company because anybody out there, even Warren Buffett, owns it. Buy it because you do the analysis and you appreciate it. Southwest Airlines is up 7%. Why? Came out today that Elliott Management took a $2 billion position in the company, equal to about 11% of the business. Why? They sat there and said they think Southwest is relying on past methods. Their computers are antiquated. I agree with them on that. But I don't agree with them on the past methods. I do believe that there's a reason why Southwest was the only consistently profitable airline up through COVID. There's a reason for that. They did it their way. They managed their risk and their oil properly. And I do think, though, that this company, Elliott Management says, we think the stock could be $49 if they implement what we say within 12 months. Maybe. It could be $100. It could be $5. I don't like it when people say that. What I want Elliott Management to do is say, we see a lot of value that hasn't been struck yet, and we want to help with that. Because Mo, look at their income statement. They've done $26.7 billion in revenue in the last 12 months. That's higher, way higher than their pre-COVID high of 22.4.
Yeah. What about the profit?
Well, the profit's terrible right now, and that's my big thesis. At all? My big thesis is this. Their profit in the last 5 years was 0.6%, 1.5 over last year. But let's go look at before COVID. The year before COVID, they did $22 billion in revenue, $2.3 billion in profit, about 10%. Year before that, $22 billion in revenue, $2.5 billion in profit, about 11%. They've been consistently 10 to 15% before COVID in the years leading up to COVID. So I personally believe at 0.6% profit and 1.5 in the last year, they just need to get back to normal. Yes, they had a lot of issues, but this is a company that's still growing. It's still a great operator. That is my thesis on the company. Again, don't buy anything just because I own it. But this is big news this Monday morning that came out. When I go and see that Southwest is the number one leader on the S&P, I go, what the heck happened here? Now, last week, the S&P was up 1.02%, taking it to 5346.99, which is 1.9 ratio based on history going back to 1928. And that is 103% over the historical average, which means fair value based on my stock market GDP indicator is 2630. Now, does that sound doom and gloom? That's 50% lower than where we are today. That's pretty rough. But then you sit there and say, okay, well, let's go look at the 10-year cyclically adjusted PE ratio, 34.82. Historical average is 17.11, another 103% overvalued. Guys, every investment's a present value of all future cash flow. And guess what? Interest rates, you can get 90-day treasury right now for 5.4%. If you buy the 10 years of the earnings, you're at 3% return. Yes, there's growth potential there, but what premium do you need in order to justify buying stocks right now? Last week was a good week. This year's been a good year. I think that Nvidia has accounted for 40 or 43% of the S&P's gains so far. We currently have the top 3 companies in the S&P accounting for 20% of the value of the S&P. That is a huge number. I think that's actually worse than it was in 2000. Does that mean we're going to have a monster crash? I don't know. Is it more likely? Yeah. Do I think we're going to have a massive pullback at some point? I do think that. Have I been saying that since COVID? Absolutely. And my track record in full disclosure since COVID has been terrible, but I'm okay with that. Why? Because I believe in valuing myself over a long period of time. I own 17 or 18 companies that I keep adding to positions as the stock becomes cheaper. I'm a value investor. I've now taken a more bottoms-up approach to investing when before I did care about where the market was, and that's what caused so many problems for me. I care about buying good companies at great prices, and they fall further, but my thesis is still the same. I keep buying more. But unless you think that earnings on the S&P is going to double in the next 2 or 3 years, I have a hard time understanding how these values are justified.
It's tough.
It is very, very difficult. Now, one thing that would actually help the market is inflation.
True.
Because stock market GDP is based on GDP here. So the more and more inflation we have, the faster and faster GDP grows, and the lower and lower the overvaluation goes.
That's evil right now, though.
It is evil. Because look back here. The last time we were at 100 and some percent was in 2021, and GDP was only $23.6 trillion. And we were still at 1.9%. We're at the same levels we were back then. So guys, if you like this reaction, if you'd like more reactions, make sure you follow the channel. I appreciate your time.